Welcome back to Breakfast. The big banks' big profits and their home loan rates are under scrutiny, especially in Australia. The big four there, which of course own our banks, are starting to resist towing the line of their Reserve Bank. Gareth Vaughan from interest.co.nz joins me now. Good morning to you.
Good morning.
Well, of course, the RBA didn't cut yesterday, but the expectation was if their central bank had cut, it would have been a big ask for the banks to pass it on. Why?
Well, basically what the banks are saying is that the cost for them to borrow money, of course the basic fundamentals of banking is they borrow money and then they lend it on to their customers at a margin. And basically what they're saying is the cost for them to borrow money is rising. And obviously because of the European sovereign debt crisis and with the Australasian banks being dependent for about 30 to 40% of their funding on international wholesale funding markets, they're saying it's now costing them around 250 basis points over the wholesale rates to raise money. Now, BNZ recently raised 500 million euros in Europe just last week, and they say all up their funding costs were about 5% on that.
Let's just be clear though, what is more significant in how they set their rates? Is it what the Reserve Bank has the official cash rate in? Is it what they pay us as depositors? Or is it what they pay to borrow in places like Europe?
They're all factors. I mean, the official cash rate sets the benchmark, everything sort of works off that. But obviously the banks borrow both from retail deposit money, from retail depositors, and they borrow from international investors through wholesale funding markets. They all add up and make the costs of what the banks have to pay to get their money.
So does the fact that most of the central banks have rates so very low not help to offset that those international credit markets have rates so high?
It does, but at the moment, because there's a lot of uncertainty and fear in international markets, it's perhaps the bank's costs are, rising, and there's concern among investors about, banks potentially failing, especially in Europe and that type of thing. So that all works together to drive the costs up. But that said, I mean, if you take, for example, that around 5% that BNZ says it cost it to borrow money in Europe. Now, remember, that includes a margin they pay to the European investors who they borrowed the money from. It includes converting that money from euros back to the New Zealand dollar. But even at that 5%, I mean, if you look at home loan mortgage rates, the lowest 6-month, 1-year advertised rates from banks are around 5.59%, lowest floating rates around 5.65%. So even at that level, that's a decent margin for the banks. So, I mean, I think in New Zealand, I think we're a little way off the banks having any justification for not passing on an OCR cut if there was to be one.
Because we are already starting to see in Australia, the ANZ, for example, reviewing rates entirely separately on their own timetable. So could we see that here, or does something else need to get worse before that might be the case?
Look, I think ultimately we probably will see that here. I mean, these big four Australasian banks are very powerful, and if the other Aussie banks follow ANZ, which a lot of analysts over there are picking they will, then ultimately, I mean, the companies here are their subsidiaries, so they'll probably follow what their parents are doing. Thus far, they're saying no, they're not going to, but they sympathise with the views of ANZ in Australia.
Why, though, Gareth, should we believe that they can't afford to pass it on when their profits are going up and their margins are too?
Well, look, I mean, I personally think at this stage they can afford to pass it on. That's my view. I mean, as I said, I mean, if we take at face value that it's costing them about 5% to borrow their money, they're still charging us up towards 6% in terms of their advertised rates. So they can afford to pass it on, in my view, at this point. And the thing to remember too is that with those advertised rates, I mean, you can often get a lower rate if you haggle with your bank. And I think New Zealanders need to remember that, like with their power company or their phone company, you can change. There is competition out there. Aside from the big four banks, there's the Kiwi banks, the TSBs, SBSs, Cooperative Bank, and HSBC, etc. So there are options out there if you're not happy.
Thank you, Gareth. That is Gareth Vaughan from interest.co.nz.